Hi everyone, good afternoon. This is yet another presentation on our financial accounting series. This time, my topic is accounting for inventories. And this is based on chapter 6 of the same textbook, Warren Taylor Jones, Financial and Managerial Accounting. So this is the book that we use as the textbook at Alabama A&M University. And my course is Accounting 203. So my primary audience today is still my introduction to accounting students, Accounting 203 at Alabama A&M. All right, so accounting for inventories. Guys, several of my students have asked, students and colleagues have told me that, why don't you do a video or some presentations on some more advanced topics? Advanced topics such as accounting quality, discretionary accruals, non-discretionary accruals, free cash flow valuation, or residual earnings valuation, or those several different valuation models that you have. DuPont identity, someone told about accounting conservatism, cumulative abnormal returns. So a host of things that I have been talking to people over the years, sometimes in classroom settings, sometimes at seminars or conferences. Anyway, so my answer to them is that that's the topic for tomorrow. This is a regular series. I would like to complete my syllabus, and there are nine chapters that we do in Accounting 203. We have 3 more. One for cash. I'm going to do one on bank reconciliation, I hope. One on accounting for receivables, like the percentage of sales method versus percentage of receivables method. And then one on accounting for property, plant, and equipment. 1 or 2, maybe, because chapter 9 is, is very large. We have intangibles there, property, plant, and equipment, as well as intangibles. Anyway, so that is what we have on the plate. All right, so today's presentation is about inventory, primarily store ledger, or accounting for costing inventory. So this is not actually inventory valuation per se. This is inventory costing. Although we know that cost is an important constituent of stock inventory valuation, because when you value, we often follow, and in US GAAP we do LCM, lower cost or market, and under IFRS, lower cost or net residual value, or NRV. So you can see lower of the two, cost or market. So you have to know the cost and then compare it with market and then find out which one's lower. So cost is going to be an essential component of stock valuation as well, or inventory valuation. So 2 purposes here. One is profit determination. We need to know how much profit we made. And the other one is financial reporting, as I just said. So profit determination is, we know that gross profit is net sales minus cost of goods sold. So what is cost of goods sold? Cost of goods sold is nothing but net purchases plus and minus beginning and ending inventories, respectively. So if you have your beginning inventory, let's say $10, plus your net purchases, let's say $100. So you have cost of goods available for sale, $110. And then depending on how much your ending inventory is, you subtract it. If it's $30, then your cost of goods sold is going to be $80. If it's $31 instead of 30, so your closing stock or closing inventory is $31, $1 more than what we thought it was. Then your cost of goods sold is going to be $1 less. And if cost of goods sold is $1 less, then our gross profit is $1 more. So stock valuation has an important bearing on reported profit. Reported profit, what profit you report. If you can overvalue inventory, then you are overstating your profit. If you are undervaluing inventory, you are understating profit. So inventory valuation has an important, significant, important bearing on the ultimate bottom line that you're going to report. Anyway, so that's profit determination. We need to know the cost of goods sold, and to know cost of goods sold, we need to know the cost of our closing stock or ending inventory. We are going to, in this presentation, we're going to use the words stock and inventory interchangeably. In the British world and in Bangladesh, in India, in the part of the world that I was born and grew up, we used to call it stock. And now we call it inventory as well. So, and in England, inventory. So whatever we call stock, inventory, or inventory, it is going to be the closing stock of goods and commodities that we have in stock. All right, and the valuation of that is important, and on the way to valuation, we need to know the cost of it. So costing, today's presentation is exclusively about costing it. How do we know how much is the cost? All right, so profit determination is one of our purposes, and the other one is reporting in the financial statement, so in the balance sheet in particular. All right, and once we know the value, we're going to be able to report it. And to know the value, we need to know the cost, because cost could be value. If it is lower than market, then cost is value. If it's higher than market, then market is value. So value is the lower of the two. Value could be either cost or market, or NRV, net residual value. Anyway, so now the issue is that the cost of inventory is very tricky, because it depends, apparently, it depends on the assumption of flow, on the cost flow assumption. So if you have identical goods, so you've been selling, say, calculators, or you've been selling watches, identical books, and you may have received books in different consignments. Now, depending on which one you assume to have sold, not necessarily which one you have actually sold. See, the interesting thing is your assumption. So you can apply your discretion and influence your reported profit. And you notice that I'm not going to say profit. I say reported profit. That means we can report a profit that we choose. Well, accounting has some boundaries, but even within those boundaries, we have a wide area of choices. The kind of accounting policies that you adopt is going to influence, or is going to dictate what profit we are going to report. So for the time being, let's be neutral, call it reported profit. All right. So there are three major ones, but there's a fourth one as well. There are 4 cost flow assumptions related to inventory. Cost flow assumptions means we can assume that the first one in was the first one sold. So first in, first out. The first one that we purchased or acquired was the one that we sold. Or last in, first out means the last one that we purchased or acquired was the first one sold. So that means we have been selling the most recent acquisitions, the most recent purchases, so the most recent consignments. And then we could also use the weighted average or a moving average of the cost of those goods that have been being received and we have been selling. Whichever one we sell doesn't matter, but our assumption is that they would be costed at a weighted average of those that we have acquired. And then the fourth method we have is called specific identification method, where we're not selling identical goods, so we can specifically identify the ones that is sold. So specific identification is very neutral, because you are specifically costing the ones that are still here, and you're specifically assuming the ones that you have sold are being included in your cost of goods sold. All right, so let's go over these 3 methods at least. Now, for both methods, our perpetual versus periodic is going to make a difference. So the general assumption, most of the textbooks, the way they present FIFO, LIFO, and weighted average, they assume a perpetual recording or real-time recording that I said in my last video. So perpetual inventory system and then FIFO. FIFO under perpetual inventory system means that every transaction, every purchase and sale is going to be recorded in real time, whether you assume it to be FIFO or LIFO or weighted average, but every transaction is being recorded as you go chronologically. Under periodic FIFO, LIFO, weighted average, we don't do real-time recording. We wait until the end of the period and then assume that all the old ones are sold, so FIFO, and all the recent ones are sold, that's LIFO, and a mix of items have been sold, means weighted average. Anyway, so periodic and perpetual also makes a difference. All right, so now let's assume that everything for the first few minutes is going to be perpetual, and under perpetual, the first one that we discuss is FIFO. We're going to do FIFO. So take a look at this one. Here we have on 3 different dates we purchased goods. See, and these are identical goods. We had on May the 10th, we purchased one. for $9. On May the 18th, we purchased another, and this one is for $13. And then on May the 24th, we purchased a third one for $14. So same stuff, same commodities, same goods, but different prices. $9, $9, $13, and $14 respectively. And then we say we sold just one. We sold one of the items for $20. So our selling price is $20, our net sales is $20. Now how much profit we made? You tell me how much profit we made. There's no one, there's no, we're not going to be able to come up with an unanimous number as to how much profit you made, because you would say it depends on which one you sold. Okay, isn't it? Because if I sold the oldest one, if I sold this one, if I could say separately identify them, let's say I kept them in separate places. So if I sold the oldest one, then my profit is going to be $11 because my selling price is 20 minus my cost price is 9. So my gross profit is $11. But if I sold the second one, then my gross profit comes down to only $7, isn't it? 7 because my sales is still $20, but my cost of goods sold is 13 here. And then if I sold the third one, then my gross profit is only $6. So from a turnover of $20, the profit is ranging from 6 to all the way up to $11. Huge volatility here. So inventory valuation or inventory costing, which could eventually lead to valuation, can make your profit really volatile. That's why one of the accounting principles is consistency, the principle of consistency, that whatever method you follow, you have to follow it on a consistent basis. Unless the adoption or compliance with that particular policy is going to materially alter the outcome. So consistency is one of the I would say protections that we have, one of the checks and balances that we have, and also another check and balance is in some countries, and nowadays almost in every country under IFRS, that LIFO is almost prohibited. So for example, IFRS doesn't allow LIFO. It has to be FIFO weighted average, because LIFO does cause a lot of problems, because LIFO assumes that goods that have been acquired like 20 years ago could still be in my inventory. So my inventory number, the inventory value reported on the financial statements can be totally irrelevant, can lose relevance, because the inventory is actually very fresh. They may have been acquired like 2 weeks ago, but the value, the price tag I'm assigning, labeling on them could be 2 years old. So that defeats the purpose of financial, one of the purposes of financial reporting. All right, so you can see here the profit calculations under 3 assumptions. Your net sales is 20, 20, 20 under all 3, but your cost of goods sold could be 9, 13, or 14, and that's how your profit could be 11 down to 6. And your closing stock valuation, your balance sheet is going to be reporting volatile numbers, because it could be reporting if you sold the one that you bought at $9, that means the 13 and 14, $27 worth of goods are still there. There are 2 items there, 2 units, but the price, the cost of those 2 could be as high as 27. But if you have sold the $13 one, then the ones you still have in stock would be the $9 one and the $14 one. Can you see? 9 and 14. And then if you have sold, or if you assume to have sold the $14 item, then the 2 that you still have in stock would be the ones costing 9 and 13. So 9 and 13 would add up to 22. So your closing stock valuation could also be very volatile. You can see it could range from $22 to $27. So $1 more. Remember, $1 overstatement of closing inventory means $1 overstatement of not just gross profit, of operating profit as well as net profit. So inventory valuation or any valuation can be extremely important. You value one asset, any one asset, over the fair value or over the value that the truth and fairness, the true and fair requirement of financial reporting demands. If you overstep it, if you overvalue anything, especially overvalue any asset, you are overstating your profit by the exact same dollar amount. If you are overvaluing one of your liabilities, then you are understating your profit. So overvaluation of liability is has a direct effect on the reported profit as well. So the relationship between valuation of liabilities and profit is negatively correlated. Overstatement of liabilities means understatement of profit, but overstatement of assets means overstatement of profit. So the correlation there is positive between asset valuation and profit reporting. All right, so let's start with a store ledger. So this is how it looks like a lot of numbers, but I'd like you to carefully follow what we have here. So please take a look while I still hold it here. You can see we have beginning stock or beginning inventory of 100 units. So that's here at the beginning. So the first three columns, the first column is dates, then the first three or next three columns are our purchases. So these three are purchases, then cost of goods sold, and finally ending stock or ending inventory. So that's how we design it. It's going to be a 10 column statement. Sorry about the focus. 10 column statement. So let's start with the November, first of the dates. Sorry, January, 1st of January. So we have 100 units at $20. So the value of our closing stock is $2,000. You can see that's how we begin. 100 units at the beginning of the period at $20. Then you made a purchase of 200 units at $21. 200 units at $21. So with the beginning, if you add this acquisition, this purchase with your beginning inventory, now this is your closing stock. You have 100 units at $20, as well as another consignment, a consignment of 200 units at $21. So this is your closing stock after the first purchase, closing inventory. Now let's make a sale. So we are selling 130 units. We have a customer who wants 130 units. So to have 130 units, which order do you follow? Where do you pick it up from? You have two consignments here, two layers of inventory. One is slightly older, $20 each. Another is slightly newer, $21 each. So FIFO assumption, I mean, you could have picked it up from anywhere. These are identical goods. These are identical goods. You are free, if your manager allows, if your company doesn't have a particular policy that you have to use the older ones first, like in case of, if you run a restaurant, then of course I'd like you to use the older cilantro, coriander first before you start using the fresh ones, because it goes astray, it goes stale. All right. So, but here you have our accounting. We're not going to influence your inventory management. We have no say about your inventory management. So regardless of your inventory management, regardless of your shelf management, our assumption is purely your discretion, at your discretion. So 130 units is what we need. We're going to sell it, say, at $20 each or $30 each. Now, this is all about cost. So the selling price is not featuring here. So the 130 units would come under FIFO, would come initially from this lot, initially from this consignment, and then 30 units from here. So that means you'll see 100 units at $20, all of it here. But I need to gather 130 units. So I asked my manager, she says, pick up from here first, get the older ones. So I got all the older ones, and I still need 30 units. So I then go to the second tranche, second layer of stock. So here I have some more. So I pick up 30 at $21. So that's my cost of goods sold. That's what I sold. This is not my selling price. These are my costs. So cost of goods sold of 130 units. So once I have sold 130 units, what I'm left with, what is my closing stock? My first layer is gone. So I have some left from my second layer, second tranche. And there we have 170 units, 170 units at $21. So that's how you know your value of closing stock, the cost of closing stock. All right, but the older ones are all gone. You have sold it. Then you have 30 from here gone as well. So you have 170 units left. And then you make another purchase. You make a second purchase here. This time you purchase 100 units at $22 each. Got it? 100 units at $22. So that gives you this stock. You have 170 already from the previous stock 170 units at $21. And then you have now some newest ones, 100 units at $22. So that's your total closing stock. If you were to do a closed stock valuation today, then I would add just these two numbers. So that's my cost of closing stock. A total of 270 units, and this would be the cost of it. So remember, this is what you have now. Don't forget the order, because now you're going to sell 50 units. We have a small order. We want to sell 50 units. So the 50 units will go from the older ones, of course, at $21. So that price is important. The older ones are the $21 ones. So I sell 50 units at $21. That's my cost of goods sold. And that leaves me with 120 units from there. See, this was the oldest layer now. So if I have sold 50 units from there, I'd be left with 120 units at 21, and then all these newest ones are still there, 100 units at 22. This is just the multiplication product of it. And then a final sale of 30 units, another sale. For now, this is going to be the final 30 units. So that 30 would also go from the oldest ones. So there we had 120 units. Remember, we had 170, then we sold 50, we're left with 120. Now we'll be selling another 30, so that would leave us with 90 units. So 90 units at 21, and then 100 units at 22. 90 at 21 and 100 at 22. So that's the closing stock. So we have, if you add this column, the three middle columns, you'll have cost of goods sold. Cost of goods sold is the summation of, actually, this column. And then closing stock is the summation of this bottom right-hand corner, not the whole column, just bottom right-hand corner. So the total of these two numbers is your closing stock, ending inventory. All right, ending inventory and closing stock are the same. All right, so that's what happens when you make a FIFO assumption. Your cost per assumption is first in, first out. So please take a careful look and see what I have done here. All right. Now LIFO does this. LIFO is going to be opposite, but also interesting. So now LIFO, what do? We start with this beginning inventory, 100 units. You can see all the way down to your right-hand side, 100 units at $20 each, at $20, so $2,000 worth of closing stock. Then we make a purchase of 200 units, same set of transactions as we had under FIFO. So 200 units at $21. Got it? 200 units at $21. So that would make us having this stock, no difference between FIFO and LIFO so far. So 100 units at 20 and 200 units at 21. Okay. Then we make this sale of 130 units. Remember, we had a customer who wants 130 units. In FIFO, we picked up from there first, but in LIFO, we have to pick up from the newest stock, newest tranche. So we have two layers of inventory here. Be careful, two layers of inventory, and you have to use the last ones first. So now you have a customer who wants 130 units. It has to go from the latest ones. That's LIFO. So 130 would be at $21. You can see all of it from here, all 130 from here at the same price. So I'm using this layer. So that is leaving me with all 100 units. All the older ones are still here, and then some 70 units from the newer acquisition, newer consignment. Okay, 100 units at 20 and 70 units at 21 is my closing stock. 70 units. And if you have more customers, let's say, forget about this purchase. If you had another customer who wants 50, you have to again use from here, use these. So until you exhaust your newer ones, you cannot touch your older ones. So sometimes it could happen. It could so happen that all your older ones or older stock are on paper are still there. After 6 months, they're still there. Well, they may have all gone. They may have been sold, but you do not assume that they have sold. You do not give an accounting effect. All right, so now you have a second purchase here, 100 units at $22. So that's fine. We're going to welcome this consignment, 100 units at $22. So that's going to give us this stock. Oldest 100, the newer 70, and the newest 100. So 3 layers now. 3 layers, 100 units at 20, 70 units at 21, and 100 units at 22. So 3 layers of inventory. Now you have a customer who wants 50 units. It has to go from the newest. You can say 50 from the newest at 22. Even if they want just 1 unit, it has to be from the newest, unless and until this whole layer is exhausted. So if someone wanted, say, if we had a customer who wants 110 units, then I'd be using all of it, all the third consignment, and then 10 units from the second one. If I had a customer who wants 180 units, then I'd be using this, and then 10 units from the oldest consignment. So that's what is the flow assumption. We need 50 units. It has to go from the very latest. So 100 from this layer, third layer, 22. So that leaves us, all the oldest ones are still here, 100 units at 20, middle ones are still here, 70 units at 21. And then from the final, say, third layer, I had 100 units, but I've sold 50. So I'm left with 50 more. The last 50, so 50 at 22. This is my closing stock. And then remember, we had a final transaction, another sale of 30 units. Final sale of how many? 30 units. So that 30 has to again go from the latest ones. My latest was 50 units at 22. So that was my newest 50 units at 22. So that's the price we charged for these sales, 30 units at 22 too. So that leaves me with this final number of units as my closing stock, 100 units at 20, 70 units at 21, and only 20 units. Let's see, 20 units at 22. You can see the difference between FIFO and LIFO. FIFO had this closing stock. This was FIFO's closing stock. FIFO's closing stock was only 2 layers. The newest one was intact. The newest 100 units were intact at 22. You can see only 90 units from the middle one. And the first one, the oldest ones are all gone. The 90 units left from the second one at $21. So still, in terms of number of units, we're going to have the same number of units, 190, but their value or their costs are going to be different under different assumptions. So 190 units, watch it. And keep an eye, 190 units here under FIFO and 190 units under LIFO as well. Just add these three numbers, 100 plus 70 plus 20. So still 190 units, but their total value or cost is different because we assume that our newest ones are all gone, or as much as possible. Well, so that's LIFO. And then the weighted average. Weighted average requires a lot of attention, so please keep an eye on what's happening here. And weighted average, the assumption is that we would mix them up and then find an average price. But that price would not be an average of prices, but it would be an average of all the units. So it would be a weighted average. I'll show you how weighted average is different from simple average. So we find the weighted average and then issue materials or sell at the weighted average price. Our cost of goods sold is assumed to be at the weighted average price. And the closing stock is also going to be at the weighted average price. All right, so let's start. We have 1st of January, we have 100 units at $20, like the 2 other cases. 100 at 20, 2,000. And then we make a purchase of 200 units at 21. 200 units at $21. All right, so now let's mix them up. What do you have in stock? 100 at 20 and 200 at 21. So what's the average price? See, the average is not an average of the 2 prices. Had it been an average of the 2 prices, it would be $20.50. But see, the $21 items are more in quantity. We have 2 types of items or 2 layers. One was at $20, another was at $21, like 2 bags of inventory or 2, as I said, 2 tranches, 2 stashes of inventory. So one at 20, the other one at 21, but $21 items are more. There are more here, 200 units versus 100 units at $20. So the average price, the weighted average is going to be more lean towards 21 more. That's what happened. You can see the price here, $20 $20.67. So $20.67, it's not $20.50. So the easiest way to find that weighted average price is that before you write this, before you calculate it, add the value of the closing stock. So you have two tranches, two stashes. One is 2,000, another is 4,200. So 2,000 and 4,200, add the two numbers is $6,200. So divide $6,200 by 300. You have 300 units. So that would give you an average price. I repeat, divide your total cost by total number of units to have the average price. Once you have the average price, you are a king, because any purchase now, any sale is going to be at that price. You don't have to worry about FIFO or LIFO. You have a price, you have mixed them up. The issue is that I have mixed up my inventory. I bought some at $20 and some at $21, but I mixed them up. And my average price is now $20.67. So any customer wants anything, I'm going to be showing from wherever, but the price I assume, the cost of goods sold, the cost of the items that I've just sold, I'd assume that they are at average price. So they could be from anywhere. So I'll assume I'll use the average price, and the average is a weighted average of $20.67. And that's what happened here. We had a customer who wanted 130 units. 130 units are sold at $20.67. So 130 times this gives you this number total cost. And that leaves you with 170 units. See, 170 because total was 300 minus 130 is 170. So 170 units also at the same average price, $20.67. Until I receive new orders, new consignments, my average price, my cost is $20.67. Well, so we have a new consignment here, 100 units. These ones are $22 ones. These are more pricey, $22. So our average price is going to go up further. So now what we have in our stock, 170 units at that average price. You don't need to go back. You just use that average, 170 units at the average price of $20.67 plus 100 units at the price of $22. So let's find a new average. That's why we call it moving average as well. You can see the average is moving. The more pricey items you add, your average is going to creep up. The less costly, if your new acquisitions are cheaper, then your average is going to also keep going down. So here we have 270 units. The total cost is the original ones, we know 3,200 and original ones 3,513 plus 2,200 here. So add the two numbers, you get the total cost. Divide the total cost by total units. Total cost by total units to have the average price. Again, this is not an average of these two numbers. It's an average of all the units. And seeing that we have more, see 170 at $20.67 and only 100 at 22. So the price has gone up a little bit because this is more than at 22, but it is not exorbitantly high. If we had like 200, 300, and about 200 units at $22, then the average would have been much closer to 22. It's still getting above 21. All right, so the more pricey, as I said, as you keep acquiring more inventory, keep ordering or keep receiving more inventory, and if that inventory is of a higher price, then your average, weighted average is going to creep up, keep going up. All right, but the art is the same. The method of calculating the average is that calculate the total cost, then calculate the total units, divide one by the other, divide the cost by the number of units. Okay, then you sell on two occasions. First, you sell 50 units, and the 50 would be at the same price, $20, $21.16. The 50 units at $21.16, 30 units also at the same price, because in the meantime, there has not been any new purchases. Hasn't been any. So until we exhaust all the 220 units, initially 270 units when the price was set at $21.16. So from the 270, I will keep selling until there's a new acquisition, new consignment. So now my 50 units are at 2116. My 30 units are also at 2116. So that leaves me with 109. You can see from 220, if 30 units are gone, then 220 minus 30 is 190, and the average is the same. Until and unless you have a new consignment, your average is not going to change. You can keep selling, same average, but a new purchase would influence your average cost, assuming that new purchase price is going to be different from the average, which in most cases are. All right, so this is how the weighted average method works. I don't know, the focus seems to change a lot. I think I can't hold it steadily the same distance from the camera. All right, so look again, beginning inventory of 100 units at 21, then we had a new purchase, 200 units at 21, so the average has gone up a little bit. It's become $20.67. This number, total cost divided by total units. Then it's sold 130 at the same price. Then we had a new purchase, this time at $22, so our average has gone up. Then we had two sales, one of 50 units and another of 30 units. All right. So that's how the weighted average method works. You have seen FIFO, LIFO, and weighted average. So tell me what you have seen so far. The idea is that we are not selling any different units under the different cost plus assumptions. The marketing department or the shelving department, the store, the showroom, they are free to sell whatever they like to sell, whatever they negotiate, whatever the customer, whatever they promise. Whatever items customers picked up. Sometimes we don't have a discretion on sale. You know, customers go down the aisles and they pick up and they put it in their trolleys, in their carts. In America, we call them carts. In England, we call them trolleys. Okay, and I think the same in Bangladesh or in many other parts of the world. So whatever you call, what's in a name? What is important is that I have had, say, identical bottles of wine, identical bottles of shampoos, identical bottles of shaving lotions or shaving creams. Customers are picking up. I know that I bought them at different times and at different prices. So if I assume that my old ones are gone first, then I'd be selling cheaper, assuming an inflationary tendency, which is the case in most cases of life. Inflation, prices keep going up as you go. So if I assume FIFO, then my older ones, whether they're cheaper or dearer, doesn't matter. So forget about whether there was inflation or deflation. The older prices, the older items are gone. So older items means not necessarily the physical items. Older priced items, older price, the items with old price tags are gone first on a FIFO. On a LIFO, items with new price tags are gone first. I don't care which ones have actually been sold. They're identical. What I care is that I'd assume if my company follows LIFO, I'd assume that my most recent prices, most recent items with the most recent price tags are sold. And weighted average means I have mixed them up and they're all the tags are lost. So we find out an average price, and the ones that are sold have been the ones at that average price. Okay, so that's perpetual. And I'm going to show you now the comparative effects, the effects of the different methods on reported profit. On sales, there is no effect. So net sales is going to be the same. But cost of goods sold are going to be different because ending inventory or closing stock are going to be different. So my cost of goods sold will be different. Closing stocks are going to be different. And my gross profit, net profit, operating profit, all profits are going to be different. And all ratios, profit-based ratios, asset-based ratios, inventory turnover, days sales and inventory, all these ratios are going to be different because of the difference in cost per assumptions. All right, so comparing the inventory methods, comparing the three methods, the effects. You can see sales was at $30. So I assumed that we sold Well, how many units we sold? I don't have to assume. I have records here. You can see we sold 130 units in the beginning. The three sales here, 130 plus 50 plus 30. So 130 plus 50 is 180 plus 30 is 210. So we have sold, over the whole month, we have sold 210 units. How many? 210 units. So 210 units at $30. So 210 sales at $30, 210 units. So $6,300, same under that, and all the methods. But cost of goods sold are different. Remember why cost of goods sold different? I told you that your summation of this middle column is your cost of goods sold. So total cost here, summation of this column is here. So that's our cost of goods sold. Under FIFO, $4,310. You can see the number here. Just summation of this column. 4,310 under FIFO. Under LIFO, how much? 4,490. So that was 4,310 versus 490. Under LIFO, the cost of goods sold has gone up. And that's usually the case when there is increases, when there is an increasing trend in prices. So that's our cost of goods sold under LIFO. And then under weighted average, cost of goods sold is here, 4,380. That's the cost of goods sold. So I get the cost of goods sold information from here, and I get closing stock information from here. Bottom right-hand corner is your closing stock. Bottom right-hand corner under all the methods. See LIFO, bottom right-hand corner. So the total of this cell is your closing stock. Not the summation of the whole column, just the total of this cell. Bottom right-hand corner. And then cost of goods sold would be the total of this whole column. Now, there's of course something on this page. So two numbers here, two numbers plus a third number. Remember, we had three cells. We had three cells. So the three cells together had under LIFO cost of goods sold of $4,490. All right, so now back to our comparative statement. We have same sales, same net sales, $6,300 minus the three different costs of goods sold. Three different costs means three different gross profits. Three different gross profit numbers and three different ending inventory numbers. So the ending inventory numbers go onto the balance sheets. Cost of goods sold and gross profit, they remain in the income statement. All right, you can see the higher the closing stock value, the higher the profit. So let's see if that works. Tell me your closing stock value, which one has the highest closing stock value? FIFO is going to have the highest closing stock value because the prices have been going up slowly. So 4,090 versus 4,000 and weighted average 4,020, LIFO 3,910. So highest, FIFO shows the highest closing stock value, and FIFO also will show the highest gross profit number. Then LIFO shows the lowest closing stock value, and LIFO would show the lowest gross profit number. As I said, the higher the stock valuation, the higher the asset values, the higher the profits. Dollar for dollar. That's why valuation is so important. One accounting principle, one accounting policy change can dramatically alter the bottom line without shareholders knowing anything. So accounting standard setters have to be very careful, have to be vigilant. The auditors have to be vigilant, and auditors have to be also accountable to not only the company, but also to shareholders and investors and lenders. But that's a different corporate governance issue. Main thing is that for your purposes, it's important to know the importance of stock valuation, because $1 overstatement of closing stock is $1 understatement of cost of goods sold, and means $1 overstatement of gross profit, means $1 overstatement of operating profit, and means $1 overstatement of Net profit means high EPS, higher EPS. Okay. Well, now that's perpetual. Now periodic. Periodic is very interesting. And a periodic we still have, we don't have to maintain a whole store ledger. We don't have to maintain a store ledger. We just need to know when we made the purchases and at what prices. Okay, and how many units we have in stock. Remember, periodic stock taking happens based on physical inspection. We do physically verify. We find out at the end of the period, check everywhere, and collect all the units that we have and add them up. And whatever we have is whatever we have, because we have not been keeping records as what we've been selling. So we recorded them at selling prices, but the costs have not been recorded. So any shrinkage or overage or pilferage or theft, nothing can be detected. Because it may be a situation that you should have had 100 units in your inventory, but you have only 90 units. But you don't know how many units you sold, or you don't know what happened to your sales. So if you have 90 units, you assume that that's what you have. Anyway, so what happens here is that how do you know the cost of those 90? Yes, let's say I should have had 100 units, but unfortunately I don't have 100. 10 units have been evaporated or stolen or missed. But okay, I'm happy with the 90 I have, but what is the cost of those 90? Are these the oldest ones or the newest ones or an average? So periodic FIFO works like this. We assume that these 90 units that we have are from the very latest purchases. They're from the very latest price tags. So take a look here. What we have is that we have the 3 purchase records. You can see purchases on January the 1st. We had a beginning balance of 100 units. Then January the 4th, we had a purchase of 200 units at 21. And then January the 15th, we had a second purchase of 100 units, this time at $22. So these are our total 3 consignments. One is beginning inventory and then 2 new consignments. Now we know that how many units are there available for sale. Beginning inventory is 100 plus purchases is 300. So 100 plus 300 is 400 units available for sale. Of the 400 units, I sold 290 units. Remember, 290, 130, sorry, 210, 130 plus 50 plus 20. 130 plus 50 plus 30, sorry. So 130 plus 50 is 180 plus 30 is 210. So 210 units have been sold. So from 400 units that was available for sale, if I had sold 210, then my closing inventory should be 190. So that 190 had to be under FIFO. That 190 had to be from where? All of these, all 100 at 22, and the 90 from the middle tranche. That's what happened here. Closing inventory 100 at 22. I don't need to go through the whole month. I'll just take a look at my purchases and the dates and prices, and you just tell me how many units you have. If you told me we have only 5 units, I'd assume all 5 are from this latest tranche. If I had 50, then still here. If I had more than 100, say 105, then all these 100 would be in my closing stock and 5 units at 21. So that's what we had, 190 units. So 100 at 22, and then the other 90 at 21. You can see 100 at 22 and 90 at 21. So that's my closing stock. Incidentally, perpetual FIFO and periodic FIFO here in my examples, because these are, I made up these examples, and obviously I was not very smart, I would say, so I couldn't figure any difference, because the way we had only a few transactions. When we do a more rigorous store ledger, having many more transactions or more price fluctuations, then we would be able to show and highlight the differences between even 2 FIFOs, like periodic FIFO versus perpetual FIFO, because theoretically they can be different. Well, incidentally, they're not, because they don't have to be different, because there are only a few transactions, but they could be and often are different. All right, so the art here, the method is that under periodic FIFO, LIFO, or weighted average, just look at what you have and then go by your assumption. Okay, if I have 5 units or 50 or 100, 200, doesn't matter. Just keep going bottom up under FIFO. Bottom up. So assume all the latest purchases are there in stock, and then go back chronologically backward. So in our case, we had to have 190 units. So our last purchase was 100 units at $22. So we assumed that that's what we have in stock. And then the previous one was $21 ones. So 90 units at $21. So that's what is our closing inventory. Periodic LIFO goes opposite. So still the same 3 transactions, 3 sale, 1 was beginning inventory and then 2 purchases. And now find out your 190. 400 units beginning inventory of 100 plus purchase of 300. So 400 units are available for sale. From 400, we sold 210. So that leaves us with 190 units. 190 units would be in our closing stock. At what prices? 190 would be, we go back because LIFO means all the latest ones are sold. All the most recent ones are sold. So oldest, go back to the oldest. 100 units at that old price. The older price is $20. See, your 100 units at 20, just $20. So all the oldest ones are still in stock. You assume them to be 100 units at $20, and then 90 units would be from the second from the beginning. So that's $21. So that leaves us with a closing stock of 3,890. So let's see what was our perpetual LIFO. See, perpetual LIFO, this is periodic LIFO. Periodic LIFO gives us a closing stock of 3,890 units. Okay, but perpetual LIFO gave us 3,910. So slightly different, but still different. Closing stock under perpetual LIFO was 3,910, but under periodic LIFO is 3,890 units. Okay, and then periodic weighted average. Calculate the weighted average first of all the units available for sale. So the costs of the beginning inventory plus the 2 purchases, add the 3 up. So that's the total number there. We had it here, $8,400. You can see beginning inventory 100 units at $20, then 200 units at 21, then 100 units at 22. So that gave us a total purchase, and including the beginning inventory plus purchases. So cost of goods available for sale was $8,400, and number of units there was 400. So divide 8,400 by 400, that would give you the average price. And we got the average price, or weighted average price, of just $21. Nice round figure. No rounding necessary. So $21 is our average price under periodic. So now you have 190 units in hand. So just multiply 190 by 21. So that's the closing stock. You see, the cost of ending inventory is be 190 units at $21. All right. So take a careful look. See the calculation of the formula. Weighted average cost per unit, or weighted average unit cost, is equal to total cost of goods available for sale divided by units available for sale. So total cost of goods available for sale was $8,400. Units available for sale was 400. So the average price is 21. That leads us to a calculation of cost of goods sold would be how many units we sold, 210. And how many units we have, 190. So cost of goods sold would be 210 times 21 is our cost of goods sold, and the value of closing inventory, or cost of closing inventory, would be 190 at 21 too. All right. So that's it for the 3 methods: FIFO, LIFO, and weighted average under. So a total of 6 in a sense, under periodic as well as under perpetual. So if you compare the 3 profit numbers under 3 periodic LIFO, FIFO, weighted average, you'd see the 3 numbers are different. The the one that has the highest value of closing stock will be the one with the highest amount of profit and the lowest amount of cost of goods sold. So that's given. The higher the cost of goods sold, the higher the closing stock value, the higher the cost of closing stock, the lower the cost of goods sold and the higher the profit. And the lower the cost of closing stock means the higher the cost of goods sold and the lower the value of closing stock in the balance sheet. So more value, more stock value means more profit, less stock value means less profit. So it has an important bearing on your reported profits. All right, and also a couple of things, as a couple of pitfalls. A lot of people confuse. They think that physically that to implement a cost flow assumption, you have to physically follow the same cost flow, same materials flow. That is not a necessity. Okay, you could sell from anywhere, whatever you find efficient, whatever your market demands, whatever the circumstances demand, you sell from any tranche, any layer, any consignment, any box, any bag. But your cost flow assumption is purely discretionary, purely your accounting policy. You just have to disclose it. And as I said, under IFRS and well, US is the only country where LIFO is still allowed, but US is about to abolish LIFO too. So one day LIFO would be gone. It would have only FIFO and weighted average. And specific identification isn't much practiced, but specific identification doesn't need any particular method. You just, if I have say 90 units and if I can specifically identify the 90, I know their cost prices, their labels. So that's my closing stock value. All right, and the ones that I sold would have had similar labels, and then there will be their cost of goods sold. All right, so I hope this works, and please try to practice preparing these store ledgers. If we have time, we'll do 1 or 2 videos on on some actual problem solving from chapter 6 of Taylor, Warren Jones Taylor textbook, or from any other textbook. But I wish you all the best. Please watch the video, practice end of chapter questions, ask me, email me your questions, and you'll be fine. So wait for our next video on bank reconciliation statement. There's going to be from chapter 7, accounting for cash and internal control. We specifically focus, the video is going to be on bank reconciliation statement. All right, and then one from chapter 8 and one from chapter 9, 1 or 2 from chapter 9. And that should end our accounting 203 series. All right, I wish you a very good afternoon. Excellent. Bye-bye.